Yo, welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today we've got another investment video for you, and I'm going to be taking you through Freetrade's new 25 stocks and ETFs, and I'm going to be giving you my take on which ones I think are decent investable opportunities, and also some ones that you should kind of be wary of, and the things to look out for, so that if you see stocks that have these characteristics, you know to potentially be wary of them. So if you want to know my investment choices, please like, please comment, please subscribe. I'm on a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear, simple, and transparent manner. But first, let's get into the Freetrade new 25 stocks. So this is currently on my own spreadsheet, but I will definitely add it to the normal spreadsheet that I do for you guys. And what you will see is there is the tab New 7, and you'll see BlackRock World Mining Trust, LXI REIT, Foresight Solar, PayPoint, Henderson Smaller Companies, GCP Infrastructure, Sane Group, On the Beach, Alliance Tech, Edinburgh Worldwide Investments, ICG Enterprise, Mighty Group, Rank Group, JP Morgan Europe, Impacts Environment Markets, Utilico Emerging Markets, Forterra, Murray Income, Empiric Student Property, Saga, BB Healthcare, Oxford Biomedicine, and New River REIT. Also, you will see that there's 3 ETFs added: RBOT, which is iShares Automation and Robotics ETF, IUFS, which is the iShares S&P 500 Financial Sector ETF, and IUYT, which is the S&P 500 Information Technology Sector ET to the F. Now, in terms of the actual stocks, these are my sort of key takeaways. The first one I wanted to talk to you about was PayPoint. So we go over to Simply Wall Street and we type in PayPoint, not PayPal, and it loads up. Obviously, for those that don't know what PayPoint is, PayPoint provides specialist consumer payment, transaction processing, settlement, and other services and products in the United Kingdom, Ireland, Romania, North America, and France. Now, this is a look at the graph over the last year. And you can see that 1 year returns has been quite modest, 0.5%. So against its sector, etc. You can see it's somewhat overvalued, but undervalued. Apologies, but you do need to obviously look into that. The PEG ratio is pretty high as well. The future performance is pretty modest. However, when you scroll down, you'll find that the company has a really good balance sheet. They have an extremely low level of debt, which is a very, very good thing, considering the stuff that we talked about in the Thomas Cook video, and they pay a pretty decent dividend at 7.47%. So I called this out if you're predominantly a dividend investor. Obviously, they've been volatile for the past 10 years. However, the dividends per share have increased over the past 10 years. They're covered by earnings, and they're expected to be covered by future earnings as well. And it's quite a high dividend, which is good. And obviously, they've got no debt. So I think from a capital preservation standpoint, it's probably likely that you will preserve your capital with this. However, what you may expect is that you won't see that much growth, because the growth outlook is pretty poor. Although it is a little bit undervalued. So I haven't personally put it into a pending status. I'm not trying to increase my dividend holdings at the moment. As I mentioned in my last portfolio update, I'm definitely trying to introduce a bit more growth stocks into the portfolio. But for you guys, I thought, some of you guys are definitely dividend investors and you might find this one interesting. So that is PayPoint. Go check that out and definitely do your research if you want to know more. Another one I wanted to call out was GCP Infrastructure. So let's go into that one. GCP Infrastructure Investments. Lego. So this is a fund. So there is more research to be doing on this fund. I don't think you could really take the undervalue, overvalue status that seriously from a funding standpoint, particularly from Simply Wall Street. But again, a fantastic balance sheet. But one thing I wanted to call out is that obviously the net worth, the equity, and the cash, you can see is continuously and steadily rising year on year, which I think for me is a pretty good sign in terms of the stability of this fund. Obviously, a lot more research does need to go into, you know, the fund's holdings and the cost of the fund and all of those other things which I haven't looked at this stage. But I definitely thought that that was a good sign. But accompanying with that is paying a pretty good dividend as well. Only difference is some of the other dividend metrics, which are very, very important, haven't been met. But it might be something worth looking into from a fund standpoint for those of you that are a bit more passive and just kind of want to have funds that do that for you. So definitely take a look into that if you think you might find it interesting. Next thing I wanted to talk about is IEYT. Now, IEYT was also the footballs I used to play with in school, but not only that, it's a facilities company that does cleaning, refuge, and all of that other good stuff. Now, the reason why I wanted to call this out is that typically and historically, this would be not exactly, but this would be partially the type of company I might try and invest in early on, because it seems obviously quite undervalued. The PEG ratio is pretty low, which is a good thing, and it's got a good future performance outlook, which is not too high that it's a bit scary, but not too low that it's a bit like, well, what's the point? So 24.3, which is interesting from that standpoint. The only sort of negative factors is that the debt seems to be staying stable. It doesn't seem to be decreasing. However, obviously the net worth does seem to be decreasing. So that is definitely something to be wary of. And the cash doesn't seem like it's increasing, to be fair. So from a balance sheet standpoint, really, I'm definitely focused on healthy organizations as much as possible. There will be organizations that are growth companies that aren't just healthy. Netflix is an example. There might be a good opportunity with Netflix. We know Netflix has a lot of debt. So it's not the be all and end all, but with some companies it might be something to definitely be wary of. And the dividend for me was just a little bit too modest, but historically this would be something that I potentially would look further into, bar the debt situation and the pretty modest dividend. So I thought, let me call it out, and if you guys find it interesting, then definitely it might be worth interesting. The share price is £1.50 a share, so it's not that expensive if you wanted to start putting some money into that. The last one of the stocks that I wanted to speak to you about is New River REIT. I don't know why I'm doing this like jingle. Just forgive me for that. But anyway, let's talk about New River REIT. So it's a REIT, obviously. New River REIT is a leading real estate investment trust specializing in buying, managing, developing and recycling convenience-led, community-focused retail and leisure assets throughout the UK. The last earnings update was blah, blah, blah. Now, what you can see here is the graph has kind of been on a downward trajectory. Obviously, in isolation, that can't tell you that much. The last year returns has been minus 27.4%. So that is why I've started to look at past returns as well. Although it's not a true indicator of future performance, it's definitely one worth looking at. It underperformed the REIT industry. And as you can see, some other related companies, Landsec and British Land, both of these two I do hold, and I believe Freetrade also has Segro now as well. Does seem pretty undervalued. Share price is 187, and the future cash flow share price is predicted at £4.06. Obviously, some of the ratios are a bit hard to determine now. Here you can see that the future performance based only on 4 analysts is 97.8%. This for me is what I consider a cause for concern. This is a red flag. It's almost too high because it's not a growth stock. And so why is it 97.8%? And I think that this is just simply a cause of the fact that the share price has been dropping. So it's something to be careful of when you use Simply Wall Street, or if you see something else that might use the same data that says it's such a high thing. It's definitely worth looking into, particularly when you see that the past performance has not been that great. Then another thing to sort of look at is that it's not say the highest level of debt, but it's got a decent level of debt. There's a decent level of debt that's currently there. But when you're looking at the debt metrics, what you're seeing is that obviously cash is still quite low. Kind of understand that because it's a REIT, it's going to pay it all out to the investors, so that makes sense. The equity has kind of been rising, but it's plateaued since 2017. and it's starting to do a downward trend. So there's probably going to be a time when this and this start to converge. So it's something to be mindful of. Maybe there's a few years left in this, you know what I mean, in the old boy, but I don't know how long it could last for, to be fair. And also the dividend is extremely high, 11.53%, which again is another potential risk. We also know that dividend yield is in relation to share price. So if the share price now tomorrow just tanked to say 1p, then the dividend yield would be like, 900% or whatever it is. So that there is a correlation there, but that and the future performance, they're all high things. So when you look at the spreadsheet, once I put it in, you've got an undervalued status is quite high, you've got a future performance is quite high, and you've got a high dividend. You would typically think, oh, green, let's go ahead and invest our money. But actually what you'll find is that potentially is something to be mindful of. So yeah, definitely I would say that's a cause for concern if you see anything like that. If we go over to the ETFs, I have put 2 ETFs into a pending status. Pending simply means that I'm going to look into it further because it might feature within my portfolio. Right now, I do need to reduce my holdings, so I'm not really trying to add unless I actually remove something else. And in one of these scenarios, that actually might be the case. So the first one is RBOT. iShares Automation and Robotics. So for those of you that have been following my journey, you do know that I have Legal and General Robo Global, which is also an automation and robotics ETF. The difference here though is that the ETF cost is 0.4%, whereas the Legal and General one, as you can see up here, is 0.8%. So it's almost half the cost. It's not almost, it's half the cost. It's half the cost. It's much cheaper. They both don't pay a dividend. So from a dividend standpoint, I'm not losing out anything on that standpoint. The only difference is the performance for the Legal and General for the last year was 21.34. At the time I did this, it's probably changed now because it's rolling. And then for the last 3 years, 81.91. However, it's a little bit more modest here, 6.06 and 57.18. But there is definitely a potential with this. So if you type in RBOT, and I'm on the iShares website where you can kind of evaluate all of their different ETFs, and obviously it gives you all of that information. Looking at the holdings, I think some of the holdings it definitely shares with Legal and General, which is good. So from that standpoint, if it holds, I would say 50-60% of the same funds, obviously it's going to be at different weightings, then I've not got that much to lose, bar obviously the amount it's weighted and maybe a few other activities in terms of sampling and all the other stuff that it might do as well. And then also I wanted to just have another look at the chart from this standpoint, and what you can find here is that you can just see obviously it's quite a new fund, and if you look at it over the last 3 years, it was doing really well, and now it's kind of plateauing, but it might potentially start doing well again. So again, it's something for me to look into a little bit more. This is not to say that I'm absolutely going to invest in this at all, but this is just to say that it has piqued my interest. It does feel like it could be a good ETF to potentially purchase, so I am going to look into it more before I make any form of decisions, and obviously I'll definitely keep you guys posted if that is the case. The next ETF they had was the S&P 500 financial sector, 0.15% in terms of costs, which is pretty good. No dividends, it's accumulating 6.54 and 58.68, so a similar performance to RBOT. I don't really want to be getting into anything financial at this current time, just because there's so much uncertainty with the market, even though this has had some very good historic performance. So maybe that's a mistake, but I think it just doesn't feel like the right time to be getting into financial sector, although this is going to be predominantly US financials, which might be a little bit better than the UK situation. It's not piqued my interest at this current juncture, but that might change in the future. The next one, which did pique my interest, is the S&P 500 information technology sector. Again, it's 0.15%. If we look at the last year's performance, 15.26, the last 3 years, 91.47. There's no dividends, it's accumulative, but it's a pretty cheap ETF. and it's had a relatively decent performance. So if we look more into IEYT, and I'm going on the iShares website. I also do use justetf.com, but I think it's quite nice to show you a few different things as well. So here we can see the all of the details of the fund, what it's there to do. Now, if you look at the graph in this instance, what you'll find is if you look at, say, the last 3 years, it's had a bit more of a trend upwards. You can see 2018 there was a little bit of a dip, but it started to trend upwards. I feel like it's similar to the S&P 500 graph, to be honest. But obviously I will have to look into that a bit more. If I hit all, what happens there? Okay, so this is since inception. Inception has had a pretty decent trend line upwards. Obviously there was this dip in 2018, but it's had a pretty decent trend line upwards. So that was interesting. There was something else that was... Oh, you can't see. Maybe I have to zoom in. I don't know. We'll try something. No, it's not showing. It's not clear. There was something else about the index, but it's not showing. So if I find out, I'll do another video on that. It was quite interesting. If we go into the holdings, we can see obviously some of the top holders: Microsoft, Apple, Visa, MasterCard, Intel, Cisco, Salesforce, Adobe, IBM, PayPal. I hold none of these stocks except if they're in the S&P 500, which I know some of them are. So I hold them via the S&P 500, actually, is probably what I should have said. And if you go to all, it has 72 holdings. And if I go to a random page, you've got things like Applied Material, Global Payments, Micron, Autodesk, some things that we talked about previously. It's got HP and Motorola. It's got things like Akamai, Hewlett Packard, so some well-known tech companies and organizations as well. Western Union is in there. There's a few little things. So it's mainly obviously US stuff, but I think it's interesting. Now, would I replace this with the S&P 500? No. So I said only one of the two new ETFs is potentially a replaceable ETF, which is for the LNG, automation, robotics. There's definitely no reason to have both. But in this scenario, I probably would have this as well as the S&P 500. Just because I think the S&P 500 for me is just, again, like I said, it's like my retirement fund. I consider that my pension. That's the way I personally like to look at it. I really want to see this specific graph behavior thing that it was doing, and it was so interesting. But for whatever reason, you know what? Let me try it with the financial IUFS, because I think it's interesting and it'll be good for you guys to actually see this. So I am winging this right now, and if it works, it works. If it doesn't, it doesn't. I apologize, but I do want you to see this. So that's the reason why I don't want to kind of just let that slip. So if I go to all, and I did something, I do not remember what I did. Basically what I did, I had an index as one graph, which was blue, another graph in green, and what it actually showed was how the specific ETF was performing better than the index for that specific sector, which I think is definitely a good thing to show you. I know why, because I looked at it for INRG, and that's the one that's actually got an index. See, I knew there's a reason. So I'm going to show you INRG, because I've been re-looking at this as well, which is the Global Clean Energy ETF. And, I hold some of the stocks that's already in this, like First Solar, but I'm starting to look at this and I feel like, maybe this is a potential buying opportunity. So yes, this is what I want to show you. So you can see that the green line is the specific ETF in question, and then the blue line is the index, the S&P Global Clean Energy Index in US dollars. And what you can kind of see is the performance of the green line, not in that time frame, you can't, but in this time frame you can see how it started to trend above that as well. See if there's a better time frame to look at. Oh no, 6 months, 3 years, 1 year. It looked better before. Oh, whatever. You get the idea. Anyway, I think if there's other iShares ETFs that you're interested in, my recommendation is to definitely plug it into this iShares website. I'll leave the link in the description. And if they do have an index, see the performance versus the index, because that might be another metric, another indicator to basically assess, the performance of that ETF and whether or not it's worth doing. I don't know if Vanguard have a similar thing. They may or may not do, so it's worth checking out. But definitely for iShares, they have this, which I think is a pretty neat feature, which I wanted to obviously give you guys the information of. So yeah, to sum up, in terms of the stocks, nothing really there that's going to tickle my fancy per se, so I'm not worried about having to research or buy anything. But in terms of the ETFs, there are two ETFs I'm potentially interested in: RBOT, which is automation and robotics from iShares, and IEYT, which is the information technology sector. And obviously with this scenario in the iBots, I will definitely look to see that as a replacement to Robo Global, should I get that. If I don't get it, then obviously Robo Global will stay there. But it will definitely be as a replacement. I won't have both because I'm not made of money. It's just no point. Yeah, I hope you found this video useful. If you did, please like, please comment, please subscribe. If there's any of the stocks in the last update that's come out that you want more information on, then leave it in the comments and I'll get back to it as soon as I possibly can. The reason why this video was late is because Freetrade only released the 25 stocks yesterday, so they were late, and then obviously I was late. So I don't know if they're going to do one on Friday. It'll be interesting to see if they're going to wait until next week, but they might do another 25 on Friday. If they do, then on Friday I'll definitely have another 25 stocks for you that I've reviewed. If they don't, then obviously I'll do it whenever they can. Other than that, have a great week. Take care. If you've got any questions, please leave it in the comments. Please like, please comment, please subscribe, and I will catch you next time with another investment video. Peace.